Hi, welcome to The Financial Verdict, the channel dedicated to providing you with valuable information to help you thrive. In today's video, we'll explore the important information that should be considered when deciding whether to treat your LLC as an S-Corp for tax purposes, when it would be beneficial, and when it wouldn't. Hi, I'm Rikwah Shu. I'm an attorney in the United States, here to provide general information. This is not legal advice. Let's get started with some fundamentals, and no better way to get rolling than clearing up some misconceptions. The best way to conceptualize a limited liability company is that it's a business legal structure that combines the pass-through taxation of a partnership or sole proprietorship with the limited liability of a corporation. It is important to understand that an LLC is not a corporation. A corporation is a separate business entity with shareholders who elect the board of directors to run the day-to-day operations. The default and most common selection for incorporating is the C-Corp, defined by Subchapter C of the Internal Revenue Code. A C-Corp is subject to corporate income tax on its profits, and its shareholders are also subject to additional taxation on dividends they receive, known as double taxation. On the other hand, an S-Corp, defined by Subchapter S of the Internal Revenue Code, passes corporate income, losses, deductions, and credits through to their shareholders, avoiding double taxation. When an LLC elects a different tax classification, such as an S-Corp tax status, it remains an LLC but chooses to be treated as an S-Corporation for tax purposes. This election allows the LLC to take advantage of the benefits of an S-Corporation while retaining its flexibility in terms of management structure and administrative requirements. It's important to note that an LLC does not become a corporation through tax election. It is only taxed like a corporation. Often, when people talk about converting an LLC to an S-Corp, they are referring to the election for an LLC to be treated as an S-Corp for tax purposes. The legal process of conversion, which changes the business entity type from an LLC to a corporation, is different and less common. It's crucial to understand the distinction and to avoid costly mistakes. Understanding the nomenclature and being precise is important. As a side note, don't assume that just because you've hired a lawyer that he would critically think and analyze whether the objective he thinks you've relayed makes sense to do. Plenty of lawyers never stop to think, does the performance of this action serve the ostensible purpose that my client is attempting to advance? A competent lawyer takes time and diligence to find, and for a business owner, think of that time you spend as an investment into a time searching for the right business partner. A good lawyer will save you a lot of headaches and money in the long run. Let's move on to discuss pass-through entities. A pass-through entity is a business structured not to pay federal income taxes directly. Instead, the profits and losses pass through to the individual owners who report them on their personal tax returns. LLCs are common examples of pass-through entities, making them popular choices for many small business owners due to their simplicity. Yearly requirements for an LLC can vary depending on state and business activities. Common requirements include filing an annual report with the state's Secretary of State, filing state tax returns, maintaining proper record keeping like meetings and minutes and financial statements, complying with federal and state employment laws, and fulfilling specific federal tax obligations based on the LLC's classification. To see an example of a properly set up LLC holding company with subsidiaries to minimize tax obligations, legal risks, and maximize profits, check out this video. Now, let's focus on the benefits of electing S-Corp taxation for an LLC. The primary advantage is the potential tax savings. Unlike a traditional LLC, where all net income is subject to self-employment taxes, an S-Corp allows for potential tax savings by splitting income between salary and distribution. The salary portion is subject to employment taxes, while the remaining profits passed through as distributions are not subject to self-employment tax. The IRS requires the salary paid to be reasonable, considering factors like industry standards, job responsibilities, experience, and geographic location. The IRS wants to prevent you from paying yourself an artificially low wage to avoid self-employment taxes. So practically, what does this mean? For most people, it means don't get too ridiculous. For example, paying yourself minimum wage while performing a high-level function that's netting you 10 to 1 is probably going to get you audited and in trouble in a matter of time. What's reasonable then in the quantitative sense? Though individual businesses differ quantitatively, we can analyze known public examples and make an educated speculation that solopreneur businesses are pretty safe at 50-50 split and getting progressively shakier towards the 70-30 split, while anything more aggressive than that will disproportionately generate greater audit and compliance risk. So let's play this out with an example. Scenario 1, we have an LLC sole proprietorship without S-Corp election. Let's say the net income is $100,000 for a year. Self-employment tax rate for Social Security and Medicare adds up to 15.3%, so that comes to $15,300 for the year. Then, of course, income tax on the remainder is calculated based on that individual's bracket. Scenario 2, we have an LLC elect S-Corp tax treatment with reasonable salary and dividends at 50-50 split. The same net income of $100,000 is now split to salary at $50,000 and dividends at $50,000. Self-employment tax on 50 now comes to $7,650. No self-employment tax is applied to dividends. Of course, the dividends are taxed at the individual's qualified dividend tax rate like anyone else. Now, obviously, to get to an accurate estimate of income tax in a live scenario, additional information is needed, such as filing status, deductions, and credits. But this rough layout shows that even a 50-50 model is saving you $7,650 per $100,000 net, and this isn't even aggressively contemplated. What else comes with S-Corp election? Well, if you're looking to reduce taxes even further and want to save for retirement, enrolling in SIMPLE IRA, which stands for Savings Incentive Match Plan for Employees' Individual Retirement Account, is a viable option. The SIMPLE IRA allows an employee to make pre-tax contributions of up to $15,500 with a catch-up contribution of an additional $3,500 if over the age of 50 as of 2023. The employer can match the employee's contributions dollar for dollar for up to 3% of the employee's wages. Because you are both the employer and the employee, you will gain the benefits of the pre-tax contributions on the employee side and the deduction of the employer's contributions on the business side. This option is not available to you with a traditional LLC because you don't pay yourself wages. Rather, you take an owner's draw. Electing S-Corp taxation status does not alter the limited liability protection provided by the LLC structure. Personal assets generally remain protected from business liabilities, assuming proper business formalities are followed. Don't commingle, keep meticulous and separate records, always. Keep in mind that the S-Corp status has eligibility criteria, such as having fewer than 100 shareholders, issuing only one class of stock, and having eligible shareholders, such as individuals, certain trusts, and estates. Other entities like partnerships, corporations, non-resident aliens, and certain trusts are not eligible shareholders. Now, what reasons are there for an LLC owner to not elect S-Corp? If you're coming from my holding company video, if the primary purpose of the holding company is to own and manage investments or assets such as stocks, real estate, or intellectual property, and it doesn't engage in active business operations, electing S-Corp taxation may not be beneficial. The tax advantages of an S-Corp may not even be applicable in this context. I would caution my audience against the quote, financial gurus trying to sell you a methodology predicated on utilizing an S-Corp holding company with qualified subchapter F subsidiaries. For most small business owners, not only is this not necessary, it does not serve the best interest of the business in many circumstances. It certainly should not be a one-size-fits-all approach. For multi-member LLCs, the existing operating agreement may invalidate the S-Corp election. As the most common example, any provision in the operating agreement that may disproportionately allocate distributions, income, and deductions in relation to the member's ownership percentage is going to cause problems. If the members cannot come to a new understanding with different consideration and agree to modify the operating agreement, election is probably not the best idea. An S-Corp offers no flexibility to how income and deductions are allocated that are not in proportion to the shareholder's stock ownership interest. If you have a partnership that was formed with any special agreement beyond what the shareholder compensation adjustments under the code would permit, electing S-Corp will cause problems. Many real estate investments utilize partnership entities to include entity-level indebtedness in the partner's tax basis of his ownership in the entity. This allows the deduction of losses in excess of contributed capital and also allows the receipt of non-taxable cash distributions. You cannot include entity-level indebtedness in your tax basis of your stock as a shareholder of an S-Corp. An S-Corp is generally not a good vehicle for real property small businesses. Another example is that distributions of appreciated property by an S-corporation to a shareholder result in gain recognition as if it were sold to the shareholder at fair market value. Compare that with a partnership where the distribution of appreciated property to a partner in most circumstances does not recognize gain. These are just some common examples and by no means an exhaustive list. Please consult with a competent attorney in your jurisdiction to weigh all pros and cons before proceeding. If an eligible LLC decides to proceed with S-Corp tax election, it should file Form 2553, election by a small business corporation, with the IRS. The form must be filed within the first 2 months and 15 days of the tax year the election is intended to take effect, or at any time before the tax year begins. Once the LLC is granted S-Corp status, it must continue to meet the ongoing requirements to maintain that status, including continuing to abide by the eligibility criteria, properly documenting and maintaining corporate records, such as shareholder meeting minutes and resolutions, which is now no longer optional. If you ever lose S-Corp status by failing to meet ongoing requirements, at a minimum, the entity will be punitively taxed from the retroactive date of the initial ineligibility and incur a 5-year ban from S-Corp status. The S-Corp must also file annual tax returns using Form 1120-S. This form reports the corporation's income, deductions, and tax liability. The LLC must also provide Schedule K-1 to each shareholder, which shows their share of income, deductions, and credits. As an S-corporation, the LLC is required to pay employment taxes for its employee shareholders. This includes withholding and remitting federal income tax, Social Security tax, and Medicare tax from employee wages. The LLC must also pay the employer's portion of Social Security and Medicare taxes. This is now no longer as simple as just taking an owner's draw whenever you feel like. And of course, depending on the regulations of the jurisdiction where the LLC operates, it may have its own specific state tax and compliance requirements. Some gurus posit that having an LLC elect S-Corp status is a sufficient vehicle to raise outside capital because S-Corp election gives the LLC a credible corporate image. That is a reckless position. If you're raising any significant amount of capital, and I'm not talking about a one-off 50 or 100 grand from a friend. If you need real capital, and even if you never plan to go IPO, an LLC or an S-Corp in any form is not the right legal business structure for that. You need a C-Corp for its ability to issue multiple classes of stock like common and preferred shares. This flexibility allows for various investment options, making it easier to attract investors with different risk preferences. Let's be real. No one other than friends and family is going to give you large sums of money without preferred stock because investors need to know if you go bankrupt and need to liquidate, they get theirs first. Further, the 100 shareholder cap rule and the stockholder eligibility rule makes the S-Corp the wrong choice for raising capital. The bottom line, should you elect S-Corp taxation for your LLC or convert it altogether? The question is really, is the juice worth the squeeze? For solopreneurs that do not require additional investor capital, ask yourself, will the amount of additional savings in self-employment taxes, retirement accounts, health and other business write-offs justify the increased administrative load and expense? You do the math, and if the additional savings per year makes sense to you compared to the extra work, go for it. For small businesses that require significant investor capital, if the business has passed the seed stage, has a minimum viable product, or is already doing sales and it's at the early or growth stage and considering venture capital or private equity money, it needs to be a C-Corp. You're not really going to be taken seriously if you come to the table, nail your pitch, and when your investors ask to see the papers, you're still structured as an S-Corp. Whatever the case, but especially partnerships with real estate holdings, check the operating agreement and tax consequences of any potential tax election. You may just be trading the self-employment tax for a much bigger problem. I want to keep posting free content because I believe anyone who desires financial success and is willing to work hard and smart to obtain it should have every chance to succeed. And open information is a prerequisite towards the ideals of a true meritocracy. If this information has been helpful or entertaining to you and you'd like to see more, please do me a favor and hit that like and subscribe. Please feel free to comment on what you'd like to see next. Thank you all for tuning in. Until next time.